Hey guys, welcome back to the channel. Today we'll be resuming Class 10 Economics, Chapter 3, Money and Credit. This is part 2 of a 4-part series, so if you haven't watched part 1, then I'll leave a link in the description. In part 2, we'll be discussing about bank activities. So we'll start with what is a bank. A bank is a financial institution, and people or customers can deposit money in banks. And these deposits are known as demand deposits because the money that you deposit can be withdrawn at any time or on demand. So every month we get our salary, and obviously we don't spend our entire salary. We usually set aside a small percentage as savings, and we can deposit these savings in a bank to keep it in a safe and secure place. So banks create and mediate an interesting relationship between those who have surplus cash, who are the customers, and those who are in need of cash, who are the borrowers. And so the banks are the central intermediary. Customers deposit their money in banks, and the banks in return pay them interest on deposits. And with the deposits that the banks have in their storage vaults, they use this money to lend to borrowers who are in need of cash. So banks take money from customers and give that money to borrowers, and the borrowers pay interest on the loan, which is an additional amount on top of the principal amount that they borrowed. So banks give customers interest as a gratuity for storing money in their bank, and borrowers pay interest on the loans. And so an interesting point to note here is that the interest that banks charge on loans is far higher than the interest that banks charge on deposits, simply because the loans from interests are their main source of profits. So who regulates banks? Obviously there has to be some organization that supervises the financial activities of banks. And in India, that's the Reserve Bank of India, or the RBI. The RBI creates the monetary policy, which again sets guidelines for banks and in a way supervises them. And the main function of the monetary policy is to define CRR, SLR, and loan activity percentages. And although this looks like Greek and Latin to you right now, it'll make a lot more sense very soon. So this is how banks store their money in 3 main outlets. 81% of the money is for loan activities, 15% is for demand deposits, and 4% is the cash reserve ratio. So we'll look at each of these. The cash reserve ratio is the percentage of money which banks reserve with the RBI. And the reason they do this is that if banks ever run out of money when customers withdraw deposits, then they can count on the RBI because they already stored a certain percentage of money with the RBI. Currently it's 4%, so 4% of the bank's deposits have to be reserved with the RBI. So coming back to this, as you can see here, 4%. So why do they define these ratios? Mainly because if banks give away 100% of their deposits as loans, then they won't have any money to give to their customers if any customer comes in to withdraw money. So that's why they set aside a small percentage in case any customer walks in and decides to withdraw some money. So that's cash reserve ratio. And to understand this better, let's look at a diagram. So banks are the central intermediary. Customers deposit money. To illustrate this with more comprehensiveness, let's look at some money values. So suppose the customers deposit 100 crores. So the banks have to reserve 4 crores or 4%, which is 4% of 100 is 4, with the RBI. So the banks have 96 crores as assets. Now loan activities. You can lend money to others through this. The banks lend money to others through the remaining percentage that they have with the demand deposits. So an easy formula to determine this percentage is 100 minus the cash reserve ratio percentage plus the percentage of demand deposits is equal to the loan percentage. But this demand deposit still doesn't make much sense. So customers with surplus cash deposit money in the banks, and it can be withdrawn at any time. That's why it's called a demand deposit. This percentage, so essentially a bank has to keep 15% of its demand deposits in the bank. They can't give that percentage out as loans because, again, like I mentioned earlier, in case a customer walks in to withdraw the money, the bank can't surrender or show open hands because the customer has every right to withdraw the money at any time. And so banks keep 4% of the money with the RBI and another 15% in the bank in their storage vaults. And this money cannot be touched at any point. It's on the off limits because it's strictly for customers that want to withdraw the money. It's not for sanctioning loans. So this percentage is called statutory liquidity ratio. So let's stop calling it demand deposits. We'll call it the statutory liquidity ratio. And liquidity is essentially the rate that any asset like gold or land or other securities like stocks or bonds can be converted to immediate cash. So usually gold and land are difficult to immediately convert to cash. So that you can see that their liquidity is low. But cash, it's already highly liquid. So it has the highest liquidity, like cash, paper cash. So statutory liquidity ratio is the percentage of money which banks must store in the form of cash, gold, or securities. And securities are essentially just stocks and bonds. So banks have to store either cash, gold, or securities, and this is off limits only for customers and cannot be used to sanction loans. So that's 15%. So 15% it's a statutory liquidity ratio. 4% is the cash reserve ratio, and the remaining 81% is for the banks to give out loans or to sanction loans. So coming back to how banks store money, we can look at the same diagram. Suppose a customer's deposit 100 crores and 4 crores, as I mentioned earlier, goes to the RBI as a part of the cash reserve ratio. So the banks have 96 crores of asset. We have to subtract 15 crores as the SLR value, and we would get a grand total of 81 crores. So if customers deposit 100 crores into the bank, if the bank is possessing 100 crores worth of demand deposits, then excluding the CRR and SLR, they have 81 crores to give out as loans. So I've been talking about loans this whole time. Why are banks dependent on loans so much? Well, banks are also an enterprise, and their only source of income is the interest from loans. The principal amount is not income because they're giving their own money, but interest is an additional amount on top of the principal amount. So that's their profit. The types of interest are interest on deposits and interest on loans. The interest on deposits is partially a liability, and the reason I say partially is because if you have a higher interest rate, then more customers are willing to store their demand deposits in your bank. So that means you would have more money to give out for loans, and that could rake in more profits on interest on loans. So that's why it's partially a liability, interest on deposits, because on one hand, you have to give money to the customers on top of the money that they deposit. But on the second hand, you're building customer loyalty, and you're also incentivizing demand deposits in your bank. And interest on loans are obviously an asset because it's a main source of income for banks. So what did we learn in today's video? We learned about what a bank is. We learned about the regulatory authority behind banks. We learned about the different forms of storage that banks use to safely store their money. We learned about cash reserve ratio and the statutory liquidity ratio. And we closed on why banks depend on loans. So part 3 will be on sources of credit, so stay tuned for that. And as always, thank you so much for watching. I hope you had a great learning experience, and until the next video, this is Nishal Tube signing off. Peace.